this video I'll provide a review of AT&T and what I personally look for when evaluating potential dividend stock purchases. In the first section of the video, I'll run through what the company does and how they make money. Then I'll look at some of the numbers and metrics that I find useful in evaluating companies. I'll analyse the dividend history and also the company's revenue, net income and cash flow. And finally, I'll offer my own individual thoughts and opinions on the stock. So who are AT&T? AT&T are a diversified global leader in telecommunications, media and entertainment, and technology. AT&T are the world's largest telecommunications company and the largest provider of mobile phone and fixed telephone services in the United States. The company operates through three reportable business segments: Communications, Warner Media, and Latin America. The Communications segment offers a broad range of products to businesses and consumers and is split into the following three units: Mobility, which provides mobile phone services and equipment; Video and Broadband, which provides video services and sells multi-platform advertising along with broadband internet connections; and Business Wireline. This is non-wireless related services for businesses, such as broadband and telephone lines. AT&T Communications serves more than 100 million US customers with entertainment and communication experiences across TV, mobile and broadband services. In addition, it provides connectivity to more than 3 million business customers. The Warner Media segment develops, produces and distributes feature films, television, gaming and other content through a range of physical and digital formats. This segment is split into three main units: Turner, Home Box Office, and Warner Brothers. Turner, which operates multi-channel basic TV networks such as CNN, TNT, TBS, HLN, and the Cartoon Network. AT&T makes money by selling advertising on these channels. Home Box Office, which most people know as HBO. This offers premium pay TV, as well as the HBO Max streaming platform. HBO owns popular TV shows such as The Wire, Boardwalk Empire, The Sopranos, Game of Thrones, amongst many, many more. Warner Media also includes Warner Brothers, which produces TV programs and feature films such as Harry Potter, The Dark Knight series, Friends, and The Big Bang Theory, again amongst many, many more. The Latin America segment provides entertainment and wireless services to customers in Latin America and is split into two units: Vrio and Mexico. Vrio produces TV content and owns several TV channels for the Latin America branch of DirecTV, which is a company that AT&T purchased in 2015 for $49 billion. And the Mexico unit simply offers wireless services and equipment to customers in Mexico. So if we have a look at what each segment contributes to AT&T's revenue, we can clearly see where AT&T makes its money from, with the Communications segment responsible for 79% of the revenue received over 2020. Next we have Warner Media bringing in 17%, and finally the Latin America segment bringing in 3%. Let's now take a look through the numbers that I find useful in evaluating stocks. AT&T has a current dividend yield of 6.51%, and last year's dividend yield averaged at 6.51% also, so it's just remained constant. AT&T have increased their dividend consecutively for 36 years, which makes them a dividend aristocrat. This is a company that have increased their dividend every year for at least 25 years. Companies tend to try and protect that title, since many investors only own the stock for its dividend. Over the past 5 years, the average dividend per share growth rate was 2% per year, and during the past 10 years, the average dividend per share growth rate was 2.1% per year. So this is quite a low growth rate if I'm being honest, but it is still a growing dividend all the same. As AT&T reported a loss over 2020, the payout ratio is currently a negative 278%. This just shows the proportion of earnings a company pays shareholders in dividends. I will discuss the company's earnings later on in the video for more clarity. But for now, let's have a look at AT&T's historical payout ratio, just to see if this is common or not. As you can see, the graph indicates that 2020 was a bit of an anomaly, where if we exclude 2020, the average ratio was 83%. I tend to consider around 80% as being a high ratio, so ideally I would like to see this reduced. The market cap of AT&T is $230 billion US, which classifies it as a large cap company, and makes it the 24th largest company in the US by market cap. I do like these large blue chip companies in my dividend portfolio, as they tend to be mature, stable organizations, and the dividends tend to be more reliable than smaller cap companies or new startups. AT&T has a current share price of $32.24, which does put it in the top end of the 52-week price range, but there hasn't been a great deal of price volatility during this period. The current price is probably a little high to me when you compare it to the 50-day average of $30.92 and the 200-day average of $29.49. So these averages and the current price shows that there has been a slight pump recently. So now let's look at the dividend history of the company. We can clearly see a nice steady upward trend, where the dividend has doubled from $1.01 in the year 2000 to $2.08 in the year 2020. This is clearly very positive as a dividend investor, as it shows me that the company is not only committed to paying dividends each year, but also increasing them too. Businesses that are able to sustain dependable dividend payments and also grow them at a steady rate can provide a solid return for investors over the long term. Now let's have a look at the chart showing AT&T's revenue, cash flow and net income. I do think it's important to evaluate a company's dividend history, but we also need to look at the profit generating potential too, as the income and cash proceeds will determine future dividend payments. The first thing I notice is the huge numbers here. We can see revenue in the range of $130 to $180 billion, which is pretty incredible. And it's nice to see that revenue has been increasing over this period, although we can also see a slight decline from the middle of 2019 to now. Net income is a little worrying. As we can see recently, this has fallen into negative numbers, which indicates that the company has made a loss. With AT&T's revenue remaining fairly constant, this indicated to me that there must have been a large expense somewhere, as the formula for net income is revenue minus expenses. Looking into this further, I saw that AT&T had a $15.5 billion impairment charge at the end of 2020, which would explain this. An impairment charge is basically an accounting treatment where a company reduces the value of an asset that it considers damaged, unusable, or worth less. So in this instance, AT&T have decided that their video business, which would relate to DirecTV, isn't worth as much as they paid for it. Therefore, AT&T have felt the need to reduce the value of those assets on the balance sheet to reflect this, which in turn also decreases net income. This is what's called a non-cash expense, so they don't actually lose physical cash as a result of this. This does, however, make me want to look at the profit margins, just to see how competent the management are in controlling expenses historically. Obviously, with the recent loss that was made, we have a negative profit margin currently. But looking historically at the period on the graph, we can see an average of 10%, which I think is perfectly acceptable. A good margin does vary greatly by industry and size of business, but as a general rule of thumb, a 10% margin is considered average, 20% good, and 5% low. The cash flow for the company does look excellent and has remained consistent too during this period, averaging around a $20 billion cash inflow each year. This is a phenomenal number and very pleasing to see, as at the most fundamental level, a company's ability to create value for shareholders, either through business growth or dividends, is determined by its ability to generate positive cash flows. So for AT&T to have a consistent and reliable level of cash inflow each year is really pleasing to see, and bodes well for the future. AT&T are clearly very good at generating cash each year, but what do their cash reserves look like, should they ever need to fall back on them? Well, looking at this graph, it does look relatively good. They last reported a cash in hand balance of $9.7 billion at the end of 2020. 2017 does jump out straight away on the graph, but AT&T purchased Time Warner in 2018. So it looks like this cash was borrowed towards that acquisition. And if we have a look at the proceeds from issuance of long-term debt section on the financial statements, we can see this jumps up by about 40 billion in 2017, which would explain this. To translate that into something a bit more understandable, it just means that they've taken out a loan to borrow this cash and it's hit their bank account. So what is my opinion on AT&T? I feel that AT&T really divides opinions amongst investors. Some view it as an undervalued, stable dividend machine, and others view it as a debt-ridden catastrophe waiting to implode. Speaking of the debt, I do notice that a lot of investors frequently talk about AT&T's high debt levels, so I wanted to look into this in more detail myself. I will say that debt isn't always an issue, and shouldn't immediately be a red flag. Most businesses take on debt to fund business activities and to facilitate growth. Unless you're one of the very few companies with zero long-term debt on the balance sheet, debt is part and parcel of doing business. Obviously, in a perfect world, I would love to see either zero or minimal debt on a company's balance sheet, but that's just not realistic. AT&T's debt has risen from the acquisitions of DirecTV for $48.5 billion in 2015 and Time Warner for $85 billion in 2018. As you can see from the graph, AT&T had around $154 billion of debt in December 2020, which is about the same as the year before. However, it does have around $9.7 billion in cash offsetting this, leading to a net debt of about $144.3 billion. Debt can devastate a company if it becomes unmanageable, and investors should pay attention to this. But each company is different, and along with debt, I think investors need to review how the debt is serviced. Looking at the interest expense on the financial statements, we can see that this has reduced from $8.4 billion to $7.9 billion. Interest expense basically represents interest payable on any borrowings. This reduction was mainly down to AT&T taking advantage of the low interest rates and refinancing their current debt, which is always a smart move in my opinion. Similar to when you take out a personal loan, business loans have a date in which the loan must be repaid. I obtained a list of all of AT&T's debts and the date by which these debts must be paid. It's quite a heavy read, so I turned it into the graph that we can see now. This just makes it easier to see how much debt AT&T need to pay off each year. So I do agree that the debt on face value is a massive amount, but it's actually split into more manageable chunks over a very long period. Look at the maturity dates that run all the way to 2097. The next few years are arguably the most challenging for AT&T, with the highest amounts falling due. But after that, providing AT&T don't take on any more debt, the current debt levels do drop quite significantly. Remember as well from our cash flow chart earlier, AT&T is a company that has had an average cash inflow of $20 billion over the last few years, which would be more than enough to pay off these debt repayments. One other really important point to note is that 90% of AT&T's debt is fixed rate, which mitigates any risk against rising interest rates. So AT&T's management know exactly what the loan repayments are and know that there won't be any nasty surprises further down the line. It's for these reasons that, for me, I just don't see the debt being as big as a problem as other investors might. But that's just my personal opinion. Regarding AT&T's communication segment, looking into their most recent investor report, it's very pleasing to see that mobile phone subscriptions are increasing, as are broadband subscriptions. And over 2020, AT&T added 1 million new phone subscribers and 1 million broadband subscribers. Looking at this graph of the market share for wireless subscriptions in Q4 2020, we can see that AT&T has a massive portion of the market, nearly 50%. Given the colossal size of AT&T's network, taking into account the 5G infrastructure and ability to service homes across the United States, it makes it near impossible for new competition to enter the market. I also see a really bright future for Warner Media, HBO, Turner, and Warner Brothers are world leaders in creating premium content. They operate the world's largest TV and film studio and own a world-class library of entertainment. For these reasons, I think this segment of the company could continue to grow into a revenue-generating giant. Management expects to see the HBO Max subscription base grow to 120 to 150 million by 2025. If these projections turn out to be accurate, this performance would mark a substantial increase relative to the company's earlier projections in 2019, when AT&T was calling for US subscriber targets of 50 million and global subscriber targets of just 75 to 90 million. Just to add some context, if we now compare HBO Max to other popular streaming services, we can see that HBO has some way to go to catch up with the market leaders. But they do own some of the world's most popular TV show and film brands. Also, we need to remember that HBO Max was only launched in May 2020, so it's a relative newcomer to the market, but is already making up ground on the competition. I just want to also touch on DirecTV. In 2015, AT&T purchased DirecTV for $48.5 billion. DirecTV is a satellite pay TV provider, similar to cable TV providers, but rather than using a wire to carry the video signal to your home, DirecTV sends the signal through the air via satellites. DirecTV hasn't been anywhere near the success that AT&T would have hoped for, and to be honest, it's been a bit of a disaster of a purchase. We can see from this graph that subscriber levels have declined dramatically since the start of 2017. AT&T, recognizing the troubles this acquisition is costing them, sold off a stake in DirecTV in early 2021, reaching a deal with private equity firm TPG for $16.25 billion, in which AT&T will continue to own 70% of the satellite service. This is a costly mistake, but one that I feel AT&T are looking to rectify by cutting their losses. It remains to be seen whether they'll look to sell off the rest of their holding in the future. As with all investments, there is an element of risk involved. I do feel like AT&T is one of the more riskier stocks in my portfolio, but I'm prepared to take that risk in return for the generous dividend yield, and I'm banking on their Warner Media segment growing in popularity over the years, and therefore growing revenue. I do like business models that have reoccurring revenue, which AT&T does through the form of subscriptions, either subscribing to their mobile phone service, broadband, or video streaming services. This creates a reliable monthly cash flow for the company, and this in turn will help plan future operations and drive the business forward. AT&T have a real strong foothold on the mobile phone service and broadband market in the US, and if they can now continue to grow their streaming platforms, then I can see AT&T really flourishing over the next 5 to 10 years. I currently hold 32 shares of AT&T, and I've not added to my position recently and would likely wait for it to drop under $30 before considering adding more. Remember that this isn't investment advice, and you should always do your own research and due diligence before making any share purchases. I hope that you've enjoyed this stock review and taken some value from it. If you have, then please like the video and subscribe to the channel to make sure that you don't miss any future videos. Also, please let me know what stocks you'd like me to review in the comments section below. Thanks again for watching, and I'll see you in the next video.